Imagine waiting forever online for Taylor Swift's Eras Tour tickets. The moment they go on sale, they're gone. Then you check resale sites, and they're just 10 times the original price. It's frustrating, and yet it happens again and again, not just with concert tickets, but in financial markets too. So this brings us to our topic today, from Taylor Swift tickets to financial markets, how behavioral biases distort price mechanisms. Here's a quick overview of what we'll cover today. And I'll start by walking you through the first part. According to classical economic theory, prices are supposed to reflect the balance of supply and demand. When prices deviate from the true value, market forces like rational buyers and sellers are expected to push them back to equilibrium. This idea underpins two major theories in economics. The supply and demand model, which states that prices adjust to match the quantity supply and demanded, and the efficient market hypothesis, which claims that asset prices always reflect all available information. In theory, if prices get too high, buyers stop buying, and if they fall too low, sellers hold back. Through arbitrage, rational actors exploit price gaps, which should, over time, eliminate them. But reality often tells a different story. Behavioral biases like herding, loss aversion, and endowment effect can disrupt this self-correcting mechanism. Instead of price returning to their fundamental values, they sometimes spiral further away. So our thesis today is simple. Behavioral biases can overpower traditional market mechanisms, leading to persistent mispricing. To explore this, we'll walk you through three powerful case studies. The Taylor Swift ticket market case, where emotional attachment and fear of missing out defy the law of demand. The Tesla stock boom case, where over-optimism and confirmation bias push the valuations far beyond fundamentals, and the ARKK innovation ETF case, where endowment effect and herding caused a spectacular boom and bust cycle. Together, these examples reveal just how fragile the rational market really is when human psychology enters the scene.
Now let's begin our case study. Upon determining the topic of our presentation, we found an article, How Taylor Swift Funds Broke Economics. Well, the title is somewhat exaggerated but quite interesting. So our case study begins with the Taylor Swift Eras Tour ticket market case. Ticketmaster prices for Eras Tour in North America range from $49 to $499. Quite fair and affordable, right? Well, you set an alarm and log in at Ticketmaster on time, get into the queue and see tens of thousands of people ahead of you. 1 minute later, sorry, the tickets have already been sold out. You have to turn to the ticket resale sites such as StubHub, only to find that ticket prices have skyrocketed and exceeded the original prices by several times. Look at this graph. The Eras Tour ticket resale prices are especially high in North America and could be up to $3,000. This case reflects the failure of the supply and demand mechanism. Traditional theories assume that market prices are determined by supply and demand, and that if prices rise above or fall below the equilibrium point, the market will eventually push them back. In this case, however, supply is fixed while demand is distorted by behavioral deviations. As a result, prices surge further from the theoretical equilibrium point. Behavioral economic theories point out that consumers do not always act rationally. They may be influenced by emotions, cognitive biases, and market trends, pushing prices to deviate from equilibrium. The main behavioral biases playing a role in these cases are as follows. First, endowment effect. Swifties who successfully grabbed tickets, they highly overestimated their emotional attachment value. Therefore, they feel reluctant to sell their tickets even at eye-watering prices. Second, loss aversion. Those who fail to snatch tickets would rather pay a huge premium to buy resale tickets than missing the concert because of FOMO, fear of missing out. Third, herd behavior. When you go night surfing on X or Instagram and see fellow Swifties sharing their tickets bought on resale sites at sky-high prices, you would also be more willing to follow them and pay a large number of money to snag one. In conclusion, the market failed to self-correct price deviations through the supply and demand mechanism since it is overwhelmed by behavioral biases. Thus, ticket prices continue to rise far above the equilibrium.
Now let's talk about financial market. First, look at the stock market case Tesla. Between 2020 and 2021, Tesla's market capitalization once exceeded the combined value of all traditional automakers, even though its production and profits were much lower than those of Toyota or Volkswagen. This shows a serious failure of information efficiency. According to the efficient market hypothesis, stock prices should fully reflect available information. But in Tesla's case, the market overreacted to the electric vehicle revolution story and ignored basic financial data. At the same time, arbitrage mechanism failed. In theory, rational traders should sell overvalued stocks and buy undervalued ones. But with Tesla's high volatility and unpredictable investor sentiment, even professionals avoided shorting it, afraid of being squeezed by the crowd. From the behavioral economics perspective, several key biases were at play. Herd behavior. Many investors blindly follow the rising trend, further pushing the price beyond its fundamentals. Confirmation bias. Investors selectively focus on positive news like Tesla's future potential and ignore red flags such as production delays or regulatory risks. Over-optimism. People overestimated the profitability of the EV revolution and underestimated the competitive edge of traditional automakers. Loss aversion. Even when analyzed word of overvaluation, many investors refused to sell, fearing regret. As a result, despite continuous skepticism, Tesla's stock price stayed irrationally high until a correlation finally came in 2022. Now let's look at the fund market ARKK Innovation ETF. In 2020, ARKK focused on disruptive innovation and attracted massive retail inflows during the pandemic. Its price surged over 100% that year, but in 2021, fears of Fed rate hikes and shifting sentiment triggered a crash. ARKK lost more than 60% of its value. This again shows a breakdown of information efficiency. Investors bought into the innovation narrative, ignoring weak fundamentals. Fund prices should reflect public information and follow economic logic, but ARKK's price was completely detached from reality. Arbitrage mechanism also broke down. During the crash, rising transaction costs and shrinking liquidity stopped rational investors from correcting the price. Emotions, not fundamentals, controlled the market. Key behavioral biases also played a role. Herd behavior. Investors followed each other, buying high out of fear of missing out and selling in panic. Confirmation bias. People saw only the positive side of innovation, ignoring overvaluation and risk. Over-optimism. Investors believed innovation guaranteed profit and underestimated macro risks like interest rate hikes. Loss aversion. Many refused to sell even as losses mounted, until panic selling caused a full collapse. In the end, ARKK's price stayed far from its fundamental value for too long, and when the crash came, the correction was brutal. This highlights the structural fragility of the fund market when viewed through the lens of behavioral finance.
So to wrap everything up, let's take a step back and look at the big picture. Across all three cases, Taylor Swift tickets, Tesla stock, and the ARKK Innovation ETF, we see the same underlying pattern. Behavioral biases disrupt the market's self-correcting mechanisms, leading to persistent price distortions. In the ticket market, fans are influenced by loss aversion and fear of missing out. That breaks the normal supply-demand mechanism. With Tesla, hype and herd behavior overwhelmed the rational valuation, and even arbitrage couldn't bring the price back to earth. In the ARKK case, the optimism loop quickly turned into a panic loop, showing how behavioral feedback can destabilize the even diversified funds. So why does this matter? First, consumer lose, not just money, but access and fairness. They pay far above value, not because of scarcity, but because of emotion. Second, investors are misled. When markets are driven by hype, even smart people get caught up in the story instead of the data. They can make decisions based on noise instead of fundamentals. And thirdly, capital is misallocated. Money floods into trending assets, leaving more productive sectors underfunded. So what can we do about it? We believe there are three key responses. First, promote financial education, so individuals can recognize when emotion is driving the market. Second, improve policy and regulation, especially in markets vulnerable to hype and manipulation, like ticketing or ETFs. And finally, encourage rational long-term investing instead of chasing short-term excitement. Let's end with a simple but powerful reminder. Maybe not all hype is worth the price, even when it's Taylor Swift. When we understand how behavioral biases influence markets, we can make better decisions as investors, as consumers, and as future economists. These are our references. Thank you.